This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. Okay, we're going to go through question 3 of the June 2010 paper F9 exam. And so first of all, let's have a read of the requirements, as you would do in the 15-minute reading time. And always look straight to the requirements. Don't waste time yet looking at the body of the question. But the requirements, part A, identify and comment on any errors in the investment appraisal prepared by the trainee accountant. 5 marks. So note for part A, it doesn't want any arithmetic. At a very quick glance at the body of the question, you can see there is what appears to be an investment appraisal. At first glance, it looks fairly normal. Years 1, 2, 3, 4, 5, the flows down the side. But clearly from part A, there are some mistakes. And our job, again, part A, no arithmetic, part A is simply to state, to identify what the mistakes are and comment on them. Part B, prepare a revised calculation of the net present value. So part B, given that we know there are some mistakes, part B wants us to do it hopefully properly. We're simply going to rewrite the appraisal that's in the body, but we're going to correct the errors. Now that's 12 marks, but part A and B very, very much go together. As you'll see, I would do them both at the same time, because as we're preparing the correct appraisal, as we go through line by line, hopefully we'll spot the mistakes while we're correcting it. Part C is completely separate. It says, discuss the problems faced when undertaking investment appraisal in the following areas and comment on how they can be overcome. So no arithmetic involved at all, no calculations, it's just writing. But 3 problems there, all of which should ring a bell. Number 1, assets with replacement cycles of different lengths. You should have been through in your studies how to deal with replacement, but no numbers here, simply writing. Separately, number 2, an investment project has several different internal rates of return. Again, something else you should have seen and were asked to write about. And thirdly, the business risk of an investment project is significantly different from the business risk of current operations. Well, again, that should ring a bell, capital asset pricing model. However, they are 3 completely separate things, so even if one of the 3 worries you, it doesn't stop you being able to deal with the other 2. But 2 things there are important. One is that, as I've already said, there's no arithmetic, it is just writing. But secondly, look at the marks. It's 8 marks, and although clearly you do want to get as many marks as you can't just ignore part C, you can't be expecting for very much with 3, asking you to write about 3 things for 8 marks in total. It's only going to be 2 or 3 marks for each one. And so he's not expecting a long essay. It really is 1 or 2 lines about each of those 3 problems separately. And what I think is always worth considering is when one part of it like that is completely written and is separate from the other bits, I think it's worth considering doing part C first. You can do the parts in any order. I'm not suggesting wasting ages on part C, but you should be able to think of a few points and get half the marks pretty quickly. But the danger is, if you do as most people do, if you do the arithmetic first, parts A and obviously part B, there is the danger that if something goes wrong or if it ends up harder than you expect, that you end up having no time to do anything for part C, and then you're only being marked out of 17, and I know in theory you can pass, but if something's gone wrong, you're not going to get full marks, and things become a bit more scary. Again, I wouldn't waste ages on part C, but really, without too much thought, you should be able to write 1 or 2 lines about certainly 2, if not all 3 of the points. And if you can simply get half the marks in 5 minutes or so, it's a good start. However, rather than confuse, I'll do it in order. But the one thing I certainly am going to do is A and B together. I think to do them separately is silly. Help the marker, though, I would head up one sheet, part A, where I'm going to identify and comment on the areas, leave the rest of the page blank, head up the other sheet, part B, which is where I'm actually going to do the revised calculation. And I think the most sensible way is to start on the revised calculation, but every time we find a mistake, I'll go back to part A and I'll write it down. You know, both bits do need to be there. If you haven't written part A, you're going to you're throwing marks away. However, let's start on part B and do it the way I said. And we'll follow their layout. There are 5 years, so 1, 2, 3, 4, 5. I'm almost certainly going to need some workings. And so, perhaps even on a third sheet, it's still part B, but I'll put workings. Whether or not I need those remains to be seen, but let's have a go. We'll start with the appraisal they've done, but there are these notes. So, how do we normally do it? We normally start with sales, the variable cost, the contribution, as they've done there. But before we start copying their figures, let's have a look. Number 1, the initial investment is 2 million. Well, fine. For the moment, not relevant. It's the future cash flows I'm interested in. But look at notes 2 and 3. 2 says the selling price is $12 a unit, current price terms, but there's inflation at 5%. Variable cost, $7 a unit. The inflation is 4%. Well, there's our first problem, that I'm not going to check where they got their figures from, but the contribution, remember, is selling price less variable cost, but we can't put them both together if they're inflating at different rates. We're going to have to treat the two separately. We're going to have to look at the sales revenue each year, and separately the variable costs each year. So let's have a go. First of all, the sales revenue. All right, a bit of workings. Year 1. We know how many units we're selling. It's 250,000, and incidentally, just as they've done, the trainee accountant, work in thousands. The examiner won't expect to see things to the nearest dollar. So the sales are 250,000 units. It says the selling price is $12 a unit, but it's at current price terms. And if you're ever told a cash flow is in current prices, it means that if you were paying the $12, if you're selling it now, it would be $12. But in a year's time, there'll have been a year's inflation. In 2 years' time, 2 years' inflation, and so on. And so the actual revenue, it's $12 a unit, but at time 1 in a year's time, it'll be, 5% higher? So multiply by 1.05 to inflate. 250, $12, 1.05. Sorry, my calculator went wrong. I get 3150. And so, first year sales, 3150. And similarly each year. Now, in the exam, don't show masses of workings. You know, my workings there, it's clear what I'm trying to do. It'll If I've done something wrong, I'll lose the mark. But it's clear what I'm trying to do. And I really think the rest of them you can do on your calculator without wasting time writing it down. I mean, just for your benefit watching me, I will write down year 2. Year 2, 400,000 units. At current prices, again, $12. But because we're talking about a flow in 2 years' time, there'd be 2 years inflation at 5%, 1.05 squared. That gives sales of I think 5292. Now, I'm not going to write the other 3 down because, as I say, I think all it does is waste time. It's obvious what I'm doing. If I get the other 2 wrong on my calculator, they'll know it's just a silly calculation mistake, and that's only half a mark. And, you know, speed does matter. So let's put them down, 3150 and 5292. Year 3, I say I'm not going to write it, but 500, $12 a unit, 3 years inflation, so 1.05 cubed, gives 6946. And year 4, well, why not leave that 6946, whatever it was, in the calculator? Year 4, it's half the units, so I divide by 2, but there's another year's inflation. Multiply by 1.05, and I get 3647. What about variable costs? Well, exactly the same idea, and this time I'm only going to write 1 year down. But year 1, 250,000 units. Note 3, says the variable cost is $7 a unit. Again, it's current prices. So, if the flow's in a year's inflation. If it's 2 years, 2 years inflation, and so on. The inflation is 4%, so multiply by 1.04. $18.20. Now, this time I'm not going to write any more down at all. I'll put that straight on the table. Remember, it's an outflow. The others I can do on my calculator. So 400,000 at time 2. How much was it? $7 a unit. 2 years inflation at 4%. Gives me 3028. Time 3, 500,000 units, $7 a unit, and 3 years inflation is 3937. And finally, time 4, I get 2047. Now, I think the examiner, in his answer, then wrote down what the contribution was, but in fact, there's no need. Remember, we're setting up the cash flows. So, I've got the sales revenue, I've got the variable costs. What else? Fixed costs. But let's look at the note. Is there one? Yes, note 4. Fixed overhead costs are 500,000 a year. Current prices, inflation 6%. But look at note 5. 200,000 a year of the fixed costs are development costs. They've already been incurred and are being recovered by an annual charge. Well, 2 things that go together here. First of all, it's a sunk cost. We've already spent the money, and we're only after extra cash flows, incremental flows. And secondly, it is only cash flows we're after. You can recover them, you can charge your profit statement any way you want. But the only extra future cash flows, 200 has already been spent. It's only the extra 300,000 a year. So it's 300,000 a year, but there's inflation. The fixed costs, Again, I'll only write down year 1. It was how much? The extra 300,000? 200, remember, is a sunk cost, so it's extra 300. But its current price is inflating at 6%. And so the flow in 1 year, 300 times 1.06 is what? 318. And we certainly don't need to show any extra workings here, because this time it's the same amount each year at current prices. And so each year it'll simply go up by 6%. So in the second year, multiply the 318 by 1.06. I get 337. Next year, another 1.06, 357. Another 1.06, 379. So, we're doing well. However, remember one thing. We're well on the way with what? Part B, the revised calculation, but Part A wanted us to identify and comment. And we've already dealt with several errors there. But even though we've dealt with it in Part B, and we'll get the marks in Part B, we won't get the marks of Part A unless we've specifically written them down. So let me go back and write those down. Only briefly. Remember, it's 5 marks, and we've already found a few errors, and there are obviously some more to come. And so, what I'll write is, firstly, sales revenue and variable costs. Inflate at different rates. And so need dealing with individually or separately. You can phrase it in various ways, but that's more than enough for that bit. What else? The fixed costs. The trainee has brought in 500,000 fixed costs. But how much was it? The development was 200,000. Was a sunk cost. You don't need to use that word. If you want, 200,000 has already been spent. It's only the additional 300,000 a year. That is relevant. Okay, now let's go back to where we were. Two extra bits there. We dealt with fixed costs, but if you look back at the trainee, they've brought in depreciation. Well, depreciation's never brought in discounted cash flow because it's not a cash flow. They've also brought in interest payments, and this is quite a common little trick in the exam. We will be paying interest, we are paying cash, however we always exclude interest payments. And the reason is that later when we come to discount, the discounting itself is accounting for the interest. Bringing in the cash interest payments would be in a sense counting it twice. So we'll ignore depreciation and interest payments, but they are relevant in Part A. Part A, depreciation is not a cash flow. It should be ignored. And separately, interest payments are dealt with in the discounting and so again should be ignored. All right, back to where we were. As a result, our operating cash flows are how much? 3150, 1820, 318, 1012, 1927, 2652, and finally 1221. But now there's tax. Now you're probably aware there are two ways of dealing with tax, and it depends what you've been taught, what you've learnt, which way you do it. I think the examiner shows this answer both ways, but I think the easiest always is, first of all, ignore capital allowances, work out the tax on the operating flows. So these are the operating flows. The tax on the operating flows. What's the tax rate? Note 7. If you look at the end of Note 7, we pay tax 1 year in arrears at a rate of 30%. So it's 30%, but because it's 1 year in arrears, the tax on the first year is 1012. At 30% is 3.6304, but it's 1 year later. So a tax payment of 304, and similarly, year 2 is 1927. 30% of that is 578, but it's 1 year later. Year 3, 2652. 30%, 796, 1 year later. And finally, 1221. 30% is 366. And so that's a really easy mark. And as long as you're neat, and do be neat, I think I'm being pretty neat, even if something's gone wrong in your operating flows, you'd still get full marks, whatever there are, for doing the tax correctly on your figures. You don't lose marks twice, when it's just one mistake. What else? Well, there's the capital flows, there's the original cost, which I'll show at the end, but there is the scrap proceeds. They've done that correctly. They've said 250. I think that's right. Note 8. Scrap at the end of 4 years is 250, so an inflow. But there's the other bit of the tax. We've worked out the tax on the cash profits as though there are no capital allowances. There are going to be capital allowances, so we'll save tax. On the capital allowances. So again, a bit of workings. Capital allowances. Note, where is it? Note 7. It says it's 25% reducing balance. And the tax is 30%. So, the original cost was 2,000. The first capital allowance, it's 25%, which is 500. And in a minute, it's 25% each year. It's reducing balance. Remember, though, although the allowance is 500, the tax will save, albeit 30%. Our taxable profits will be 500 lower, so the tax will be 30% of 500 lower. The tax we'll save is 150. When are we going to save it? Well, there can in fact be complications about the timing, but these days he doesn't bother. We'll assume we'll save the tax the first year we're paying the extra tax. A year in arrears time 2. So there's 304 would have been payable on the cash profits before allowances. Because there are allowances, there's a saving of 150. Well, we're going to have to do it for 4 years, so let's rush through it. Second year, 25% of the reducing balance of 1,500 is, oh dear, what's wrong with me? 375. The saving, 30% of that, is 112, 113. Doesn't matter which way you round it. The reducing balance now becomes 1125. So the third allowance, 1125, 30%, 338. I'm sorry. 1125, it's 25%, which is 281. The saving at 30% is 84, and the reducing balance goes to, I think, 844. And remember, we carry on like that each year except the last year. Now, this is only a 4-year life, and so the 4th year is the last. And in the last year, you don't get 25% reducing balance. You get all the remaining allowances. You simply deduct the scrap proceeds, which here were, I think, 250. And whatever's left is a balancing allowance, or, had it been more, a balancing charge. Here, a balancing allowance. The difference between the tax written down value and the scrap proceeds we received. So we get this remaining allowance of, I think, 594 in the last year. The tax saving, I get to be 178. Now, I'm taking a while because I'm talking, but that should be something that becomes fairly automatic. And on its own is easy marks, and doing it this way, of course, even if everything else had gone wrong or you got stuck somewhere else, that little bit, once you've got it and you can do it fast, there's not much scope for losing marks. So let's do it. 150, 113, 84. And finally, what was it? 178. So I think we've now got everything. Yes, we have. So the net cash flows 1012 in the second year is 1773. The third year 2187, and the fourth year 759, and finally at time 5 188 negative. Finally, though, we need to discount. As normal, we'll multiply by the discount factor. But we need to check if they've done it right. They've put discount at 10%. But where have they got that from? It says in note 9, the real weighted average cost of capital is 7% a year. And we do want to discount at the weighted average cost of capital, but remember the real weighted average cost of capital, there's no need to write this in the exam, but the real cost of capital that's what the cost of capital would be if there was no inflation. Well, of course, there is inflation, and in theory, the higher inflation, the higher the cost of capital will be. Year by year, if there's higher inflation, we say there'll be a higher cost of capital. If there's lower inflation, a lower cost of capital. We know what the inflation is. Note 10, the general rate of inflation is 4.7%. But what we need is what we call the nominal cost of capital. The nominal cost of capital that's the actual cost of capital, in a sense including inflation. And that's what we want here. Because, and again, this is still, if you like, a teaching bit. So forgive me if I'm taking longer than I should, but I wouldn't go through all this in the exam. It just becomes automatic. But the rule is that we discount the actual cash flows which is what we've got. The cash flows we've written up are our forecast of the actual flows we've inflated. We expect those actual cash flows each year. So we discount the actual cash flows at the actual or nominal cost of capital. All right, we finished the teaching bit. The question now is, what is the actual cost of capital? Well, it's actually the Fisher effect, but 1 plus the nominal rate is equal to 1 plus the real rate times 1 plus the inflation rate. And it's the general rate of inflation that affects the overall cost of capital. So 1 plus the nominal rate. Well, the real rate is 7%, or 0.07, 1 plus the real rate, times 1 plus, well, the inflation rate, 4.7 or 0.047. So multiplying up gives us 1.12029. It means the nominal rate, all right, 0.029, I'll write it down. The nominal rate is 1 minus that, 0.12029, or 12.029%. Well, that's the rate we should discount at. In the exam, he'll never expect you to discount at a funny rate like that. Use the nearest rate from the tables. We'll discount at 12%. Well, now, it really should be just speed on the arithmetic. I shouldn't need to talk through it, but the discount factors at 12%, 0.893, 0.97712. The present values, I think those are right, but if I've made a mistake, I've made a mistake. Don't waste too much time there in the exam. It's only going to be 1 mark. It's not worth spending half an hour, even if that bit goes wrong. But it does mean the total present value, assuming my numbers are right. I get 4250. We want, however, obviously the net present value. And so the original cost was what? They'd got that bit right, I think. Note 6 was 2 million. And so the net present value, 2250. And a silly point, but a silly place to lose a mark. It does say comment on the acceptability. Well, surely because it's positive, so we would accept the project. But it's always worth noting, subject to the accuracy of our estimates. It's better if you can spell it, accuracy of our estimates. Because that's always the huge problem. That although we've done our arithmetic right, in real life, is it going to, our selling price is going to inflate at 5% and so on. Anyway, there's part B finished. Part A, though, we'd listed most of the problems, but there was one more big one, of course, and that was the cost of capital. The cost of capital used was incorrect. I'm not sure how they calculated it, but we should use the nominal rate of 12%. There's going to show workings again there. In fact, it's just the fact we should use the nominal rate. Well, there we are, 17 marks. It's not an easy question, mainly because of the time involved. It's taken me quite a while, although I appreciate I've been explaining while I was doing it. But I think in the middle of an exam, to get it completely right is perhaps a bit over-optimistic. But if you're sensible, it's an easy one to get pass marks on. And by sensible, particularly in Part B, set it out nicely. If you look at the marking scheme, they do mark each bit separately. You can afford to get some of the bits completely wrong, your fixed costs completely wrong, but you would still get those right. Obviously, if the fixed costs are wrong, it affects these, but you don't lose any marks. And if these are wrong, your tax is wrong, but you'll still get the marks. You don't lose marks twice. And so provided you're setting it out nicely, although hopefully you'll get it correct, you can afford to get one or two of the bits wrong and still get the rest of the marks and still pass it relatively easily. But that only works if you're setting it out nicely. If it's a complete mess, the marker's not going to waste 20 minutes trying to sort out where every figure came from. The danger is you lose far more marks, even if you knew what you were doing. Finally, though, Part C. Part C, as I said before, is completely separate. Now, his answer's a good one to learn from, but appreciate, as always, the examiner writes more than he expects, because he knows people learn from it. I said at the beginning, there's only 8 marks. So they can't expect you to mention more than 2 or 3 points for each item. Number 1, it says the problems and how the problems can be overcome. You could write a long essay, but I say it's just not required. All I'd write, and I'm convinced I'd get virtually full marks, for assets of replacement cycles with different lengths. I'm not going to try and teach it. I mean, it's something you should have seen. But what would be quite sufficient for the exam is this, that because assets are kept for different lengths of time, kept for different periods, it's not possible to compare the net present values directly. The solution, in fact there's more than one way of dealing with it, but the standard solution, I'll put a solution, is to calculate the equivalent annual cost for each replacement period. These can be compared. Now, as I said, given the number of marks, this isn't meant to be a teaching lecture. If you're unsure what I'm talking about, go to the lectures on the website and you'll find one on replacement and look through it. All I'm trying to show here is a sort of level that you'd be expected to come up with in the exam. Number 2, the separate appreciate each one. Investment project has several internal rates of return. It isn't unusual, but there can be more than one internal rate of return for a project, because I'm not sure if you really need this, but because of changes in direction of cash flows. All I mean there is, normally with an investment it's negative and then you've inflows, they're positive. But if you have the situation where there's an outflow, then there are inflows, then there are outflows, then there can be more than one. The problem is comparing with the cost of capital or with other projects. And the solution, well, there are several things that can be done, but the normal solution is simply to base decisions on the net present value. Finally, number 3. The business risk is significantly different from the business risk of current operations. Again, this isn't a lecture. The problem is that we require different returns. Or let me put it a different way. We require higher returns from projects with higher risk. And although I'm not going to write the reverse, lower returns from projects with lower risk, the solution is to measure the risk and use a capital asset pricing model. Now, for the last time, I think I've said it 3 times, but that really is the level that's required in the exam. I'm quite confident that would get me the full 8 marks. And the nice thing, of course, is even if, or for instance, the last one, even if the arithmetic in capital asset pricing model frightens you, it's irrelevant here. But that's exactly the sort of level you wanted. Okay, there we are. I hope that's useful.